5,000. How do we make sense of this run, Ben? How do you explain it? And do we continue to move higher in 2026, Ben?
Yeah, so I mean, I think the short answer is we continue to move higher, and the reason is this is part of the debasement trade. I think last time we spoke around the summer last year, gold was somewhere in the 3,000 range, and we talked about exactly this. And the catalyst back then was the same catalyst now, which originally was central bank buying. And just as a reminder for everybody out there, up until COVID, central banks globally were buying about 500 tons a year of gold. Post-COVID, which is when, of course, the United States printed the majority of dollars in existence, after that massive monetary stimulus, central banks globally started buying about double that amount. That's 1,000 tons. That's huge buying. It's at a point now, and they've been selling treasuries, by the way, to fund that. Now, what we saw happen in 2025 was that trade moved into the broader investing landscape, the so-called debasement trade. And we heard about it just in the last session, market domination, dollars dropping because, I think the number is at this point, 80% of all dollars in existence have been printed since COVID. And so, this is a structural tailwind behind gold. This is a fundamental repricing, and it's going to continue pushing higher this year.
Here's how my friend Peter Bukvar put it this morning, Ben. Peter, very smart guy. He framed it like this. He said the gold rally is not a safety trade. It is reflecting a tectonic shift in where global participants are most comfortable parking their money and preserving value. Also, in terms of physically protecting it in light of the continued freeze on Russia's central bank reserves. Do you agree with that framing, Ben?
100%. And I would actually underscore the last part of that because, this is something that was not well appreciated, more broadly, which was during the Russia-Ukraine conflict. The U.S. unilaterally seized Russian dollar-denominated assets. And, setting aside whether or not that was the right choice or not from a morality perspective, what that did signal to the rest of the world is, hey, your dollar assets aren't necessarily safe. And I remember even, there were allies talking. I think a minister of one of the Japanese bank, started expressing concern that, wait a second, if the U.S. can just take your dollars at any point, there has to be a safer play out there. And so, fast forward to today, and since then we've seen, gold get more of the geopolitical flight to safety bid, where historically that would have been the treasuries. So I think that absolutely hits the nail on the head, and it's no longer just the debasement trade. You're also getting the geopolitical flight to safety premium that up until recently was, the treasuries U.S. treasuries had been the dominant player.
Ben, let's say I came to you though, and I said, listen, in my portfolio right now, I got stocks, I got bonds, I don't own gold. Should I buy gold here, Ben, at these levels, or no? You would say, listen, wait for a rest, wait for a breather. There's a better entry point coming.
So that is the question these days, because again, a lot of us were pounding the table on gold early last year. Nobody was, was interested. Now, of course, we're having these conversations with clients. The short answer is we would say don't wait. Gold should be a part of the 60-40 portfolio. Now, that said, structurally, how do you get into that trade? Dollar cost averaging historically is always a good way to do that. If it were silver, I might say, be a little bit more judicious about your entry. That's had much more of a parabolic run. There's some kind of technical factors there. I mean, we're seeing it today, in fact, with option expiration putting some pressure on silver. But I think the short answer is for gold, don't wait to get exposure. Again, this is a structural. This isn't a multi-year trade. This is a multi-decade trade. This is a repricing. So it's we think it belongs in every portfolio.
What about Ben? We're talking gold. How about digital gold? How about Bitcoin? See Bloomberg with a report today. So talking about how price is stalling, volumes are limp, they say. Believers are actually looking at equities and precious metals and prediction markets, they point out. What do you make of what we see with Bitcoin, Ben? What do you see ahead next 6-12 months?
So we're actually constructive on Bitcoin this year. It sat out much of 2025, which, to be frank, I think was actually good for it as an asset class. Ironically, you're seeing a lot of people, all the memes online talking about selling Bitcoin to get into the original, the OG Bitcoin, which is gold. But again, it is part of this debasement trade, and so we do see it going forward. I think we see a bid for Bitcoin. I think especially too as we kind of start chopping through, some other parts of the capital rotation, which we're seeing with Mag 7, we're seeing with precious metals, hard assets. It's very hard to see how Bitcoin is ignored in that. So I think technically speaking, I think it was good that 2025 was kind of a sidelines year. But I'd be surprised if we don't see Bitcoin. If it's not setting all-time highs this year, I'd be surprised if it doesn't get close.
Last question quickly, Ben. Is there a level you're watching with Bitcoin? I ask only because I've seen some folks, cited as saying, for example, they're watching 100,000. They're saying, listen, it's got to trade above 100,000 for the momentum in the bull market to continue.
Yeah, I mean, I think you start to get above, the technical thresholds matter. I think really above 90 is when you start kind of seeing the CTA buyers, the hedge fund buyers come back in. It's been very range bound. We look a lot at the blockchain activity. It's, there's a pretty good bid at 85, which is good to see. I think north of a sustained level north of 90